All right, so let's start. So I'm going to step back a bit and take it sort of from the top on corporate taxes to give you a little bit more background and then get back into the models that we were discussing. So to give you a big picture sense of why I think this is a really important topic. So here's just a time series graph of corporate tax revenues in the US as a percentage of GDP and as a percentage of federal revenues from all sources. And you can see that there's been really a dramatic erosion in the importance of the corporate income tax in funding the government, where in the 1960s, corporate taxes accounted for more than 20% of federal revenue and were nearly 5% of GDP. And today it's more like hovering around 1% of GDP. And so you might think that this is because we've reduced corporate tax rates substantially in the US, and that's why we're collecting less money from the corporate tax system. But in fact, we really have not. So this is just showing you for the relatively recent years, and the same pretty much holds going further back in time, going back to the 50s. The US statutory corporate tax rate has hardly changed, right? Yet corporate tax revenues are falling dramatically. Now, the other interesting pattern that you note is that other OECD countries, you do see a clear reduction in corporate tax rates over time. And this is not that surprising because especially these small European countries have figured out that if they lower corporate tax rates, they get big firms to come and locate in their countries, which generates jobs and potentially really matters quite a bit, especially with small local decisions like that. Now, the US has continued to maintain a relatively high corporate tax rate of 40%. Yes, yet we generate less and less revenue. I think there are potentially a couple of reasons for that, which relate to the topics we'll be talking about. First, we allow lots of exemptions, and there's a lot of complexity in the corporate tax code where you get to deduct all kinds of things. And so in some sense, we might actually have the worst of all worlds where we have a high marginal tax rate, yet somehow we have a pretty low average tax rate because we're allowing lots of deductions, right? So that's exactly the opposite of what you want because you're distorting the marginal incentive to invest in the US without generating a lot of money. And moreover, the fact that all these other countries are lowering their tax rates while the US is keeping the marginal tax rate relatively high could furthermore, because of international tax competition, explain why revenues are falling in the US, right? Because as we'll talk about toward the end of these lectures, there's a lot of incentive to locate your company, at least on paper, in a low tax country, a tax haven, so that you can basically pay lower taxes with a multinational corporation and not be subject to the high marginal tax rates of the US. So a lot of people think that the corporate tax system in the US really needs serious reform because it's not generating a lot of revenue and is potentially creating quite a bit of distortion, where you've got both potentially reduced investment, distortions in the way investments funded, and international shifting, okay? And that's the set of issues that I think we want to tackle, understand both theoretically and empirically. Now, the reason the corporate tax literature I think is a bit hard to get into and difficult to do work on unless you invest in it is that there's a lot of complexity in this tax system, and it really matters both in terms of the type of research designs that you can implement and in understanding optimal policy. So there are many elements of the corporate tax system levied on individuals, on corporate profits, on different types of organizational form, and increasingly international tax provisions are highly relevant, right? So I'm going to go through this in more detail on this slide here, which I'm going to use as an organizing framework for these lectures, okay? So before we talk about tax policies, let's talk about the set of decisions a firm makes, and then we can see that there are various tax instruments that affect the firm at various levels of this process. So if you think about what a firm does, one of the initial choices it makes is how you're going to organize your firm. So an important choice in the US is, are you going to set yourself up as an S corporation or a C corporation? An S corporation is subject to the individual income tax system in the US. A C corporation is subject to the corporate income tax system. And there are limitations on what C and S corporations can do. So for instance, you can't have more than 100 non-institutional investors if you're an S corporation. So that's going to limit your ability to raise funds from the public equity market, right? So that's one choice, the choice of organizational form. Related to that, where are you going to set up your business, right? Is the headquarters going to be in the US? If it's in the US, is it going to be in a state like Delaware where a lot of companies are headquartered because there are less regulations, lower taxes? Or more importantly, is it going to be outside the US where you set up operations somewhere else so that you end up paying lower taxes? And that increasingly, as I was saying, is a very important decision. So now you've set up your company, you have some structure. Now you need to raise money to fund your investment, and there the standard choice that you make, as we were discussing in the last class, is between debt and equity finance. So then once you've raised the money, you make some investment and production decisions. And then finally, you pay back the people who invested in your company, right? So you report some profits in a given year. You decide how much you want to pay back as dividends, how much you want to pay as interest, how much money you want to keep in the firm to retain and invest in future periods, and so on. Now, our tax system it changes prices at each of these stages. And I'm going to work through this backwards. So we started to talk in the last lecture about dividend taxes and corporate profits taxes, and likewise taxes on interest income. All of these things are going to affect choices in that last stage, and naturally are then going to cascade down and affect all the choices that you might make further back in this change. How you invest, whether you choose debt or equity, how you organize yourself, and so on. So that's one set of taxes. Now, we also try to directly affect companies' investment decisions, and the primary tool we use to do that is change the way in which assets get depreciated, and that's what's called accelerated depreciation. So we'll talk a fair bit about that. And that's a tool that's commonly used as a stimulus to try to raise investment in recessions. We then also directly affect the choice between debt and equity because we allow interest payments on debt to be deducted from corporate profits, but we don't allow that for equity. And so that effectively creates tax-favored status for debt relative to equity. And then lastly, we also affect the choice of organizational form directly by having different taxes on S corporations and C corporations, so the individual versus corporate income tax system, and then the way in which we tax profits that are earned abroad. So related to issues like transfer pricing, how do we allocate earnings across countries with multinational corporations? So we'll talk about each of these. This is how I'm going to organize the lecture. We'll talk about these 4 topics, and I'm going to do it backwards. So we'll start with the last stage where we'll talk about tax policies that are affecting payouts first, okay? So this is now getting back into the material we talked about in the last lecture. I'm just going to review it very quickly because it's the foundation for everything we're going to talk about subsequently. So I'm going to structure the analysis using a stylized 2-period model of firm behavior from this paper on agency theory of dividend taxes. But we're going to take the neoclassical case where there are no agency issues, which we'll come back to later. Just to refresh your memory, we're talking about a firm that has cash holdings of X in the initial period. That firm can raise more funds by issuing equity. So the total cash holdings it has is X plus E. And then the firm chooses a level of investment I, which has some concave gross payoff F of I in period T equals 1. The firm pays out dividends in whatever cash it has left as a dividend in period 0. Okay, so we're taking a case with pure equity finance. There's no debt versus equity choice, and there you can only pay back money in the form of dividends. There's no share repurchases. We have a dividend tax rate of tau D in all periods, a corporate profits tax of tau C, and there's another asset that has a fixed return of R. Yes, Pascal. You can think of R as the net of tax return, right? So the only thing that matters is I'm not going to allow, when I do the comparative statics, I'm not going to allow changes in tau D or tau C to affect R. So you've got to have the bond being an elastic supply. You can't have a general equilibrium effect where when I change the corporate tax rate, it affects the interest rate on bonds. But if you've got a 1 minus tau I, where tau I is the tax on interest income, that's not going to do anything as long as it's fixed. Yeah. So the manager in the neoclassical model maximizes the value of the firm. And we talked about this expression in the last class, where in the first period you have the net of tax dividend payment minus the equity that you raise, and in the second period you have the profit stream that you realize, which is subject to the corporate tax and the dividend tax, except for the when you return the equity back to the shareholders, that is not subject to dividend or corporate taxation. If I put $10 in the firm and you give me $10 back, that initial $10 that I invest is not subject to taxation. It's only the profits that you earn. If you make an extra $5, that's what's subject to the corporate tax and the dividend tax, okay? So in the no tax benchmark, you invest up to the point where the marginal rate of investment, marginal return to investment equals the outside option. And then as we talked about, you can characterize behavior when there are taxes by dividing firms into two types. So-called new view firms that are cash rich and old view firms that are cash constrained. So for new view firms, the marginal return to investing an extra dollar by raising it from the equity market is strictly negative, or it's below the interest rate. So there's no incentive to raise money to issue new shares. And for old view firms, it's the opposite. They do have an incentive to issue equity and raise money, okay? And then, so just to quickly walk through this, you know, the old view firms, they set equity of 0. They split their cash between dividends and investment according to this rule, where they set the net of tax return to investment equal to the interest rate. And you can see that, sorry, this is for the new view firms, the cash rich firms. They set the net of tax return taking the corporate tax into account equal to the interest rate. So a higher corporate tax naturally is going to lower the amount you invest because it reduces the return. Now the important result here is that, which goes back to well-known work by Auerbach and others, is that for new view firms, dividend taxes have no impact on the level of investment. And just to be totally clear on this, the reason is that $1 of investment plus paying dividends tomorrow yields this payoff here, the marginal return times the net of corporate tax rate times the net of dividend tax rate. If I just pay you that dollar today, I end up paying the net of dividend tax today, right? So my investment decision is based on the relative price, the relative return to investing versus paying you the dividend today. And so you divide those two to get the relative price, and the 1 minus tau d cancels out. I've got to pay the dividend tax either way. That's why it's irrelevant what the tax rate is. Importantly, that's only true as long as tau d is fixed across periods, right? If I lower tau d temporarily, of course, that can affect the level you invest because it's going to change the relative price, right? Now, for old view firms, firms that don't have that much cash and are issuing equity in order to finance investment, they are not going to pay dividends. They want to invest all the money that they have, and they're going to issue equity up to the point where the marginal return to investment again equals the interest rate. But here now, because I'm injecting equity into the firm and I'm going to pay the dividend tax when I take it back out, I do face the 1 minus tau d at the margin. And so the important implication of the old view, which is Paterba and Summers and Feldstein's view, is that dividend tax reductions can stimulate equity issues and investment. And so they'd favor they were in support of the 2003 Bush tax cut, which lowered dividend tax rates substantially in the US, because the idea is that it would stimulate the amount that, that firms invest, okay? And the reason is that tau d does not factor out of the value function because the marginal investment is financed from external capital in the old view as opposed to internal capital in the new view. Yeah. Yeah, so you could imagine trying to do that, but that would create distortionary incentives as well, right? So suppose I say, if you have less than $1 billion of cash, I'm going to give you a tax cut. That's going to lead to all kinds of restructuring. So you're right, like the general idea that people have thought about is you want to target tax incentives to the marginal guy and not give these infra-marginal incentives. So the other point that your question brings up, which is right, is what is the empirical distribution of cash holdings across firms? Most investment is actually done by firms that have a lot of cash. If you look at it from a dollar-weighted basis, Most investment is occurring by companies like Google or Microsoft or firms that have lots of cash reserves. So it doesn't look like they're old view firms in a given cross-section. But if you think about it dynamically, every firm has to start out as an old view firm, right? Because you've got to get the money from somewhere. And so it's not totally obvious that that's the right way to think about it, okay? All right, so that was mostly a review from the last lecture. So now let's talk about what this means for tax policy and the efficiency costs of taxation. So in our neoclassical model, so just to remind you here, we're not talking about two different models, right? There's a single neoclassical model, and you have two different types of behavioral responses depending upon the parameters, basically depending upon whether X is high or not. Okay, so there's a single model, and we're going to derive a formula for the efficiency cost of raising the dividend and corporate tax in that model. So to do that, let's define the total dividend payout in present value over the two periods as the dividends you pay in the first period plus the total dividend that you pay in the second period divided by 1 plus R. Okay, this is the total, this is the size of the dividend tax base, right? This is what I'm going to apply 1 minus tau d to. So total surplus in the economy, if I just have a dividend tax, and forget about the corporate tax for a moment, total surplus in the economy is the value of the firm plus the revenue raised by the government. So why can I just add the value of the firm to tax revenue? Because firms, by assumption, we assume they have a linear utility function in a sense, right? They're just maximizing profits, which is measured in dollars. It's unlike for consumers where they're maximizing utility, which is a curved function, and we can't just add utils to revenue. So that's why we go through the whole expenditure function setup and so on. Here, it's just like the quasi-linear case. We just add the firm value to revenue. And then to derive the efficiency cost of the tax, we want to know how welfare changes when I raise tau d, right? This is the usual thing that we do in the analysis of taxation, like commodity taxes that we've discussed many times. So the deadweight cost, I'm not going to go through the details of the algebra, but it should be a familiar result to you that we have the mechanical effect that I'm taking money away from the firm. And when I raise the tax rate by 1, how much money am I taking away from the firm? I'm subtracting out exactly the size of the tax base, right? So if I take $10 of dividend taxes away from you, your value falls by $10. I mechanically collect that revenue, so that comes from the right-hand side here, right, for the government. And then I have the term that comes from the behavioral response. This is exactly the standard Harberger thing. And so then I can write that in the form of an elasticity where, quite intuitively, the deadweight cost associated with dividend taxation depends upon the elasticity of dividend payments with respect to dividend tax rates. So that's why people are really interested in knowing what that elasticity is, because it plays a crucial role in determining the efficiency cost of having dividend taxes. Now, the only difference between the old view and the new view, that formula holds in both models, or both cases, but the difference is in the old view, we predict that the elasticity is positive, right? So dividend taxes reduce efficiency, whereas in the new view, as we just established, the elasticity of dividend payments with respect to dividend tax rates is 0 because the 1 minus tau d is factoring out, right? That's the logic I was describing before. And so the same formula holds, but the elasticity is 0, so the dividend tax has no efficiency cost. And so you can see that, Alan Auerbach's view is dividend taxes are a potentially great instrument to raise revenue because they're taking money, at least in a statutory sense, directly from high-income people. So from a redistributive perspective, that looks good. And they essentially have no efficiency cost in the baseline model that he and King and Bradford worked out. So this looks like a tax that we should have at a high rate, right? And the Feldstein-Summers-Paterba view would be that no, you're distorting investment decisions, and that's potentially very detrimental for the economy if this elasticity is large, right? So they have starkly different predictions on how you want to set up dividend taxes, but they concur that corporate profit taxes are going to be distortionary in both cases, right? Because higher corporate taxes are going to reduce investment no matter whether it's Microsoft doing the investment from money it already has or Twitter doing the investment from money it's trying to raise, okay? Now, in this static setting, there's this stark distinction between these two different views, but as I was saying earlier, the more natural way to think about a firm is kind of in a life cycle model, where a firm is growing over time, right? So it starts out like a company like Twitter where it's raising equity now. And so you would think for young firms, new entrants, it's the old view description that matters. And then over time, they become new view firms, such that the marginal investment is done out of retained earnings. And so Sin has a paper in 1991 that develops such a model. And as you can imagine, the formulas for the efficiency costs of taxes in such an environment are sort of a hybrid of the two extremes that you get here, okay? So that's the theoretical background, and so you can see why there's a lot of interest in distinguishing between these two competing views to think about optimal policy, all right? And so that now takes us to the empirical literature, first on dividend taxation, and then we'll talk about the corporate profits tax. So several studies have examined the effects of tax cuts on dividend payouts to test between the old view and new view. Do we actually see dividend payments responding to the level of dividend tax rates? The new view would say no, the old view would say yes. So there's an older literature on this, which I'm not going to go through in detail, which is a traditional, either cross-sectional regressions, time series regressions. There are various identification issues, which would be common to all the other literatures we've talked about, like labor supply. So just briefly, some of the well-known papers, Paterba and Summer in 1985, they find a positive link between dividend payout ratios and net of dividend tax rates in the UK time series. Paterba reports some time series evidence in the US, but in general, I think it hasn't been totally clear exactly what's going on. You have some contradictory views because you don't have great research designs and data and so on. Now, that changed with the 2003 dividend tax cut, which was a very sharp reform that lent itself well to studying these issues. And so Emmanuel and I have a paper in 2005 that uses a simple quasi-experimental research design to study the effects of the 2003 dividend tax cut. And so what we do is we do that using a simple diff and diff design. So what did the 2003 tax cut do? Prior to 2003, dividends were taxed as regular income in the US. So if you were in the 40% tax bracket, every dollar of dividend payments that you got from the shares you owned, you'd give 40 cents of it to the government. After 2003, tax rates were just capped at a flat 15%, basically. And so you can see that for people in the highest income brackets, who tend to be the people who get dividend payments, that's a 25% reduction in the marginal tax rate. So quite a substantial change. And so we're basically going to implement a diff and diff design. It's almost, what I'm going to show you actually in the lecture is just a diff design. It's just straight time series. You can see the patterns very clearly because they're so sharp. Now, the key challenge that we face in this paper is not anything fancy econometrically. It's just plain vanilla DD. But the generic problem that emerges empirically in the corporate tax literature is that there are massive outliers, and they really matter a lot for mean effects. And so you have to think hard about how you're going to do inference when you have these outliers. So let me show you what the time series is and illustrate what I mean by that point. So this is just the aggregate quarterly time series of dividend payments in the US. And there are two types of dividends that people talk about. One are called regular dividends, which I think of as basically recurrent payments. If you own a share of Microsoft, you can expect to get a dividend payment of, I don't know what it is right now, but something like $1 per share every quarter, something like that. So many companies will have a fixed stream of dividend payments. If you buy that share, you're entitled to that stream of dividends. Obviously, there's nothing in law saying you can't change that, but changing your regular dividend payments is viewed as a very strong signal by the market empirically. And so we'll see later that when you raise dividend payments, you announce an increase, your stock price goes up a lot. And if you cut dividend payments, you're severely punished because it's viewed as like some disastrous thing must have happened if you're choosing to lower your regular dividend payments. Now, there's another way to pay dividends, which are called special dividends, which somehow, you know, again, there's no legal distinction here, but the firm pitches it as this is a special dividend. Don't expect us to do this every quarter. And there's no penalty per se in changing the level of special dividends you pay. Now, here's what I mean by the importance of outliers. So this is where the 2003 tax cut occurred, okay? So the solid line is the point at which the change was enacted, okay? When it was announced, sorry, the solid line. And then the point at which it became effective was actually 2 quarters before, at the beginning of 2003. So it was officially passed in the middle of 2003, but retroactively applied from the beginning of 2003. Often, you'll see many tax policies have that feature because you can imagine you get like a lot of lobbying pressure where if you change the tax policy effective July 1st and some huge company paid a dividend on June 15th, they're going to say, this is totally unfair. Like I lost billions of dollars because of the way you changed the policy. So they do it going back 6 months. And so then there's an issue of when exactly did the policy change occur, right? Did people know that it was going to be passed 6 months later? And we have some sense that in this case, maybe they did. And you start to see a little bit of a reaction even before the thing was officially passed and so on. Okay, now the importance of outliers. So there's this massive spike here, right, that occurred right after the tax cut. So that is driven by one observation, Microsoft paying a $32 billion dividend after the tax cut was announced. And so how are you going to treat that, right? I mean, one view is if I just take raw means, that one observation, even though I have thousands of firms, is just totally going to dominate everything in the data. And that actually ends up creating quite serious econometric problems. So you can see in the time series, you can basically see it visually. When we wrote the paper initially, we had data up to this point here. And so you could see that there was an uptick in the aggregate trend. But there have also been some other changes and so on, like there was a rise over this period and so forth. So if you just look at the aggregate time series, it's actually not that easy to do inference because if you think about the microdata, you've got a very fat-tailed distribution. And so if you run a regression, you're going to get huge standard errors if you just do OLS. So the trick, I think, in this literature is to find other moments of the distribution that are more stable, where you have much more power, okay? So let me illustrate that by doing the following thing. So this is what convinced us that this thing actually clearly had an effect. So this here is in a constant sample of firms, the 3,800 biggest firms in the US, which are publicly traded. That's all the data we had at the time. What fraction of them start to pay dividends in a given quarter? And here, so what's the difference between this statistic and the statistic on this graph? It's that we're not overweighting Microsoft relative to a small firm, right? Everybody gets an equal weight. Everybody counts as 0 or 1. And so here you can see it's totally clear that after the dividend tax cut was passed, a very large number of firms started to initiate dividend payments, right? And so another way that you can look at that is look at the time series of the fraction of firms paying dividends, not the total amounts paid or the mean amounts paid. And this trend here is what people in finance call the disappearing dividends time series trend, where firms in America are less and less likely to pay dividends. And actually a huge amount of saving in the US now happens within firms because lots of firms are just hoarding a ton of cash, okay? And so this was just constantly going down, but then right after the dividend tax cut, that trend completely reverses. So that looks quite clear, yeah. Yeah, I mean, it's, so that's a great question. It's like discussed at length in the corporate finance literature. So I think there are possibly a few things going on. So one issue is that a lot of firms retain earnings abroad and don't bring it back to the US. So there's an issue of repatriation when you have multinational corporations. And that's partly tax motivated. Another issue is maybe the structure of firms as we have more conglomerates and big firms. You know, the view is, I'm not going to pay the money back to the shareholders. The shares are still worth a lot. You can get your money out if you want by just selling your own shares. But what I'm going to do as Google is buy YouTube and buy other things and not give the money back to the shareholders and let them invest directly in YouTube, right? So you've got more of the model of I'm going to keep the cash and look for good investment opportunities. Why we're doing more of that now? Why are there more mergers and acquisitions today relative to before? I don't, not totally sure. No, but it's not, that is ultimately the view you have, right? That the manager is not going to just take off with the cash. Right.
But if it's stuck, I mean, if there's...
No, but even if I know that you're probably not going to pay dividends in the next 10 years, as long as I believe that you believe they will, if we all have the view that they will eventually pay it out or not steal it, then I can still get my money out by just selling you my shares whenever I want to, right? So it makes sense that I should value the cash within the firm as long as I think it's not going to be, wasted. Yeah. Possibly. So we know from the finance literature that the points at which firms start to pay dividends vary over the stock, vary with the stock market conditions. So when it looks like there are lots of attractive investment opportunities and the stock market's really booming, people they want to keep cash and invest and not pay dividends. So that's possibly true. So that's possibly true. I mean, but even when you repatriate, it's not that there is a tax, but you're not losing all the money. So what you're basically asking is, what are they valuing the money held abroad at? I don't know if that's being valued as if the tax rate's going to be what it is now, or we're going to see a tax holiday. We'll talk later about these temporary tax holidays that the U.S. sometimes has when you can bring money back without paying any taxes. I don't know off the top of my head how it's being valued, but you're right. That would be an interesting thing to know. Yeah, you do. No. I mean, I agree. You wouldn't pay more than $1 to get $1, but you'll certainly value it at least $1 net of tax issues, right? So a good example is like BlackBerry right now doesn't have, basically like nobody has a BlackBerry, and so it's not worth anything. But it has $2 billion of cash. And so the companies, they're still getting offers to buy BlackBerry at around $2 billion because they have that cash. No, I don't agree with that. I mean, I think the stock price should reflect both the value of investments and productive capacity and any cash that you have. You might be right from an accounting point of view, you treat the two things differently. Is that, but you don't? Okay, so. No, I think the cash is valued. But. Okay, so coming back to the tax cut, right? So from an econometric point of view, it's clear that I think the tax cut had an effect on dividend payments. But if you think about what you're trying to do inference on, it's not per se from a tax policy point of view that you care about the number of firms paying dividends. You actually care about the total amount of dividend payments, right? In some sense, you do want to weight Microsoft a lot more in your analysis than like the local small business that might have changed its behavior somewhat. And so that creates this delicate balance between wanting to do inference on the means and being able to do inference on other statistics like the fraction paying and so on. And so one middle ground approach, which is what I think we kind of adopt in this paper, and I increasingly think is the right way to do this, is suppose you assume that the elasticity of response is the same across firms, for instance. Then I can estimate the elasticity effectively off of the smaller guys because I have lots of observations on them without huge outliers. And then as long as the elasticity of response is same across the distribution, I can apply it to the full base and make a prediction about what's happening overall. So that's making the strong assumption that the elasticity for Microsoft is the same as the elasticity for smaller firms. But you can imagine trying to relax that to some extent by having some continuous thing where you allow the elasticity to vary with the size of the firm or something like that. But I think you have to get identification from the smaller firms in the corporate literature. Otherwise, you're never actually going to be able to do inference because effectively it's like you're working with 10 observations or 50 observations because the distribution is so heavily skewed. unlike with people, right, where it's also skewed but not nearly as much. Okay, so that's the basic fact that we think the dividend tax cut affected dividend payments, and I think we have an elasticity of something like 0.4 or 0.5 in that previous, the elasticity that I was describing in the previous slide, so fairly large. Now, what I think is more important in terms of the findings in this paper, so you might say from that raw fact, what should you conclude given the two models that I'd set out? The old view wins and the new view doesn't, right? Because dividend payments do in fact appear to respond to dividend tax rates. But we then, looking at the data further, realized that it actually looks much more complicated than that. And the reason is the size of, so first of all, you see responses even among quite large firms. It doesn't look like there's a heterogeneity in the response based on the amount of cash the firm had. So even the new view firms that have a lot of cash, they were responding a lot to this dividend tax cut, contrary to what you might think, based on the simple model. But moreover, if you look at the comparative statics, you see a pattern. The heterogeneity of the response looks much more consistent with evidence from the modern corporate finance literature on agency issues than the basic neoclassical model. So let me start by showing you this breakdown here. So we're showing the percent of firms initiating dividends prior to the reform. I think this is the 6 quarters before the reform and the 6 quarters after the reform. So the fact that the red bars are higher than the gray bars is just another way of showing what I showed you on the previous slide, that dividend initiation rates went up a lot after the reform relative to before. But now we're breaking this down by the percentage of outstanding shares held by the top 5 executives of the company. So that's in the public record. You can see for all publicly traded companies how the top 5 executives are compensated in a database called ExecuComp, okay? And so these guys on the left here, these, think of them as basically CEOs. They own very few shares of the company. And these CEOs over here, they own lots of shares of the company. So take an example. Bill Gates at the time owned about 10% of Microsoft, okay? So what was Bill Gates' personal incentive from the reduction in the dividend tax rate? So he personally, because he got 10% of the dividends, he got $3.2 billion when Microsoft paid the $32 billion dividend payment, right? And he personally saved $640 million in taxes because the dividend tax rate was cut from 40% to 15%. So executives who own a lot of shares in their own company, they personally have lots of incentives to respond to changes in dividend tax rates because they themselves are going to pocket that money. In contrast, the guy down here who hardly owns any shares, if he pays more dividends, maybe the shareholders are happy and so on, but he himself, his own personal incentives don't change very much when the dividend tax rate changes. And so then the pattern that you see in the graph is that the guys who own a lot of shares in their own company, they're responding a lot more to the dividend tax cut than the guys who own less. Yeah. No, because think about the marginal thing that he can do. So we're going to have a model that explains exactly this behavior, what the trade-off is, right? So why don't I just defer your question until I get to that, okay? All right, so that's one empirical pattern. Now here's another pattern that really made us think that maybe it's the personal interest of the executives that really matters. So executives are compensated not just in shares in their company, but also in options, which allow you to buy. So what's an option? Allows you to buy a share of the stock at a fixed strike price. So like I'm going to let you buy Microsoft at giving you the option to buy Microsoft at $40, okay? Now importantly, that strike price is not indexed to the dividends that you pay, okay? So if I pay a lot of dividends, it dilutes the value of the share and dilutes the value of my options. Because coming back to this question of whether the cash is valued, if I pay money out of the firm, the stock is now worth less, right? And so if I've got a $30 strike price and the stock is currently trading at 35, I effectively can get $5 from that. But if I pay a $10 dividend, now the share is only going to be worth $25, and my option has still got a strike price of $30. So I've basically lost money. So now do the same breakdown. Executives who own who have lots of option holdings on the right versus executives who have very few option holdings on the left. And it's exactly the executives who have very few options who are responding a lot and starting to pay more dividends. And the guys who have a lot of options are responding less. So again, it looks very consistent with the view that the managers are acting in their own self-interest when they make this decision and not just on the behalf of shareholders, right? The neoclassical model says you shouldn't necessarily see any heterogeneity here because in the neoclassical model, you're just hired to maximize the total value of the firm for the shareholders, and your own personal interest is irrelevant. But this very much, doesn't look consistent with that view at all. The last pattern, which is going to inform the structure of the model we set up in a subsequent paper, is in the corporate finance literature, like the work by Andre Schleifer and others, people talk a lot about external large shareholders and monitors as constraining what the firm does. So if all of us, each of us owns, a small fraction of Google or Microsoft, we're not going to spend our time going to their board meetings and trying to make sure they're doing the best thing on our behalf because it's not worth paying the fixed costs of doing that. In contrast, if you have Warren Buffett on your board or you have a big institutional owner like a pension fund, then those guys actually do have an interest in making sure you're not, you're doing things optimally, right? And so consistent with that view, you see bigger responses in firms that are held by large taxable institutional owners. And so that furthermore goes with this view that agency and monitoring really govern the nature of the responses here. And so maybe it's not old view versus new view, but rather a third agency view, which is what I'm going to talk about in a little bit, okay? Yeah. No. But think about it. No, that's right. But we're talking about, suppose this dividend tax change lasted permanently, which in fact, it's lasted for the past 10 years, right? Now you can think about expectations and so on, but let's assume it was treated as a permanent change. Going forward at that point, the trade-off from then on is between paying a dividend in 03 versus paying a dividend in 04. And the tax rate's lower at that point for both of those decisions. So we're not talking about pre-03 versus post-03, right? If you had known the dividend tax rate was going to be cut in 03, that might have affected your decisions in 02. But after the tax was reduced, now your trade-off is between paying dividends at the lower rate today or paying dividends at the lower rate tomorrow, and it's fixed from that perspective. Yeah. You can also pay through share repurchases. Yeah, you're absolutely right, actually, and that was a limitation of our paper. Even though it's a diff and diff, it doesn't solve that problem because what might be happening is you're paying more dividends but repurchasing less shares, right, in a diff and diff way. And so we weren't able to do anything about that with our design because share purchases are basically too noisy in the time series, and so we couldn't figure out if the money was coming from less share repurchases or not. But that exactly is a good segue to the next paper, a more recent paper that uses better data, which is Danny Yegan's paper that analyzes the effect of the dividend tax cut on real outcomes. That's what I'm emphasizing here, investment and employee compensation, but also, coming back to your question, is going to be able to nail the share repurchase issue, okay? Danny's paper does the following thing. So we had sort of a diff and diff design. It was mainly time series. That's why I was showing you just those time series graphs. But the diff and diff that we had is we used firms that were heavily held by non-taxable institutional owners. So think like TIAA-CREF, holding money on behalf of Harvard employees, for instance, which wouldn't be subject to any of these taxes. For a firm that's owned entirely by TIAA-CREF, the dividend tax cut is totally irrelevant, right? And so what we show is for such firms, which are not that many, there is no change in dividend payment behavior around the 2003 tax cut. And so that was sort of our control group. It's not a great control group because it's not a large set of firms, and so there's not enough power to use that to see impacts on investment or share repurchases, all of these more volatile outcomes. Dividends have the property of actually being relatively smooth, and so you can detect something using the design. Now, we were constrained by using publicly available CompuStat data on about the 4,000 biggest firms, generally the biggest firms in the US, publicly traded firms in the US. Okay, that's what CompuStat covers. The key innovation in Danny's work, he's on our team with the tax data, is that he has the population tax records, not only for individuals, but for firms as well. And so Danny uses the universe of tax records to develop a much better research design, which compares C corporations and S corporations. So now you have information not only on the C corporations, which we had from CompuStat, the publicly traded ones, especially the big ones in CompuStat, but you also have the S corporations, some of which are very large, and there are many S corporations, and you get data on them from the tax returns. And the S corporations are not subject to the corporate tax system. So they were unaffected by the 2003 dividend tax cut, okay? So just to show you why this research design of being able to compare C to S is really important. So we tried to look at investment, and a number of others did at that time as well. And you can't really get conclusive results, so that's why we don't report anything in our original paper. The way you can see that is the following. So this is just a time series of US corporate investment based on national accounts data. And so suppose I were just to try to figure out from the time series, as I basically did with the dividends, whether investment went up after the 2003 tax cut, as the old view would have predicted. You can see, like, you do the visual permutation test, you have no power here, right? There's no way you could figure that out because the fluctuations in the time series and investment are way too large relative to what a plausible change might have been around the dividend tax reduction in 2003. Okay, so that's the graph that Danny uses to motivate his design, which is the following. So after incorporating a corporation elects either C or S tax status, and here's the difference. So they both face taxes on annual profits, but for C corporations, the tax rate on dividends was cut in 2003. S corporations faced no taxes on dividend payments. Okay, so they serve as a good control group here. And S corporations, as I was saying earlier, they have less than 100 non-institutional shareholders and one stock class, but, and Danny goes to great length to try to establish this, S corporations, you shouldn't think of them as being tiny companies that are totally different from C corporations. There are actually many companies you've heard of, very big companies, that are organized as S corporations, right? So for instance, he gives the example of Home Depot, which is a C corporation, Menards, which is also a huge home supply chain, which is an S corporation, and they compete in the same markets and so on. Yeah, that's a good question. So that, if you think about that chain that I had at the beginning to organize the lectures, that organizational form decision up front is something we're going to talk about at the end, and there's evidence that when tax rates change, firms do reorganize. Danny tries to deal with that by tracking a fixed set of firms. So he has the advantage of having a panel, and so he can track a fixed set of firms over time, right? But one can also use this to try to study whether there are more C corporations now than S corporations, and there's some evidence from that evidence on that historically. Yeah, but that's why using a panel is important. All right, so here is basic results. So first, he replicates the finding that we had in our paper using this better research design, right? So C corporations shown in blue. This is the year of the reform. S corporations shown in red. Everyone's dividend payments are going up somewhat, but it's clear that C corporations have a pretty significant increase in dividend payments relative to S corporations. And then importantly, coming back to your question, this is not actually just a replication. It's better than the graph that I was showing you before, because this is now total payouts. And it's not just dividends. It's payouts, dividends, plus share repurchases. And so you can see that the tax reduction did actually induce companies in the US to return more money to the shareholders, not just return money in the form of dividends instead of buying back shares. Okay, so that's result number one, consistent with prior work. Now, the question he's really after in his paper is looking at impacts on investment and other real outcomes, right? We talked about the difference between financial choices and real choices, and there's, as you'll see, better evidence, there tends to be better evidence on finance than on real outcomes because it's harder to get to that next step of real outcomes. But now we're starting to have data and research designs where we can actually get there. And here's net investment in C corporations and S corporations. And you can see that there really is not that much of a difference. These two things track each other perfectly, and I'm not going to go through all the regressions he estimates and the robustness checks and so forth, but he estimates a very tight zero here where the elasticity of investment with respect to the net of dividend tax rate looks like it's less than 0.05 or 0.01 or something like that. So really no evidence that aggregate investment was affected by this large change, right? And so this is incredibly important because the whole discussion around the Bush tax cut was not just that you'd get firms to pay shareholders more dividends, but that this was going to be a way to stimulate job growth in the US and increase investment and so on. And it really doesn't look empirically like the largest dividend tax change in the history of the US had that effect. Likewise, you can look at total employee comp. So what's the logic here? I reduced dividend tax rates. Suppose it had, in fact, increased investment. We think there's some labor capital complementarity. I need some guys to run the machines that I just bought. And so the idea of the Bush tax cut is we're going to get firms to hire more people. And again, compare treatment group and control group, the evolution of these things is almost identical. And in fact, you have enough precision to say that there wasn't much of an impact on the number of workers firms hired either. All right? Then lastly, you might ask, okay, maybe this is, you're not seeing it on average, but maybe it's true among bigger firms rather than smaller firms and so on. And so he estimates the investment effect by the size of the firm in deciles, and you can see you get quite precisely estimated zero effects across the entire distribution. So it really looks, I think, quite convincingly that you end up, so what are the key patterns? You affect payouts, you don't really affect total investment, and you don't really affect total employment, right? And that happens among big firms with lots of cash and so on. So given all that, where does that leave us with the old view and the new view? So our perspective is neither one actually really seems to fit the data that well, right? And so the model that we currently have, and I think this still needs to be refined to fully fit the patterns in the data, is an agency model. And this is going to answer your question earlier, Nathan. So, a key idea in corporate finance models, well before any of this evidence I'm showing you here, is that there's a divergence between the interests of owners and managers of a firm. So the shareholders, we think, want to maximize profits. The reason you invest in Google is because you want to make money, right? But the CEO, and this is the key divergence, he faces a trade-off because he might actually get utility from having money within the firm. So there are many models of this in corporate finance. There's what's called empire building models, where you just like running a big company. Okay, you just want to have a bigger and bigger empire. Or it could be more specific things like there are actually papers specifically focused on private jets and how private jets respond to cash windfalls and taxes and things like that. And you could imagine like you like flying in a private jet. You'd rather do that than pay dividends. Or investing in pet projects more generally, right? So the way to think about that is if I were totally disciplined and objective and not really attached to this company, there's no way I would do this extra investment in this new market. It reminds me a little bit of like Starbucks, started opening Starbucks all over the place. And then at some point they realized they had gone too far and then they started to scale back. So maybe if you weren't totally into that line of business, you would have stepped back and said, maybe we shouldn't be doing this. But when you founded this company and you're really into it, you can imagine how you go beyond the marginal rate of return to external investment, right? Okay, so to model that and to see what it does to tax policy, we're going to just generalize the two-period model above in a very simple way. We're going to go straight to the new view. Let's, to make it simple in the lecture, firm is financed purely from retained earnings. And now the CEO has 3 options instead of 2. He can invest in the productive enterprise, the main line of business. He can invest in this pet project that he likes, but is not, the way we're going to model it is it's not actually going to generate profits for the firm, but he gets some personal utility from it. And then he can pay dividends, and the amount of dividends he pays is the amount of cash he has minus the amount he invests in the 2 types of projects. Okay? And critically, the CEO owns a fraction alpha less than 1 of the shares of the company. So the CEO doesn't own the entire company, and that's what's going to create a misalignment of his objectives with the objectives of the shareholders. So the shareholders' payout is just the firm's profits. Okay? And the firm's profits, which I'm going to denote by pi, are the dividends that you pay in the first period, and then your profits net of corporate tax in the second period, plus whatever cash you have left over, x minus d, and you bring that back to present value and multiply that by the net of dividend tax rate. Okay, so that's how much cash you get from the firm, where notice that the profits that the firm generates are based on I, not J, the productive investment, not the unproductive investment. The CEO is going to choose I and J to maximize his own personal payoff. And so he owns a fraction alpha of the firm, so he gets alpha times pi of the profits. And in the neoclassical model, we would not have that second term, right? We would just say the CEO is maximizing alpha times pi. Maximizing alpha times pi, because alpha is just a constant, is the same thing as maximizing pi. And so you're back in the standard framework where you're trying to maximize the value of the firm. But here, you also care about this. You get some utility from that pet project G of J. And so you now face a trade-off between paying dividends back and keeping the money within the firm, right? Which is exactly what's going to generate that type of behavior. So you can solve this model. There are potential corner solutions, but let's just assume that you have enough cash so that you're at an interior optimum. And then you can show that you end up having these first order conditions where, quite intuitively, you invest in the productive project to the optimal amount. Okay, if the outside option has a return of R, you're going to invest to the point where the net of tax return is equal to R. But then, now I'm assuming you have enough cash so you still have some money left over. So now you're making this choice between dividend payments and investment in the pet project. And you're going to invest, so we want you to set J equals 0, right? But in fact, you're going to go to the point where G prime of J, your personal marginal utility from that pet project, equals alpha times 1 minus TD times R, which is your personal return from paying $1 of dividends, right? So what's the trade-off here? I can put another $1 in J, that gets me G prime of J, or I can take that $1 and pay it out as a dividend. What do I get from that? I can earn a return of R on that on the external market, but I have to pay the dividend tax, so that's the 1 minus TD, and I only get a fraction alpha of the $1. If I own 5% of the firm, I get 5 cents, right? So what does that do? This is why when TD is high, you now want to do more of the pet project investment, especially when alpha is low, right? If you have a low alpha, you want to keep a lot of money within the firm rather than pay it out. So you could see that that's geared to exactly match the facts that we saw in the data, right? It's going to reproduce those patterns of heterogeneity. So that's one point, that this simple model, which is very familiar from the corporate finance literature, can explain what we see from a positive point of view. But then we think about the implications for tax policy. So what does it mean now, this agency view? An increase in the dividend tax rate is going to raise pet project investment, leave productive investment unaffected, and lower dividend payments. Okay? An increase in the corporate tax is going to lower efficient investment and leave pet project investment unaffected. Okay? So what do you end up getting as the bottom line conclusion? The dividend tax in this model actually is worse than the corporate tax. So remember where we were before, just to step back. In the neoclassical model, both the old view and the new view predict that the corporate tax generates an efficiency cost. And the debate is only whether, in some sense, the dividend tax has the same efficiency cost, which is the old view, or has no efficiency cost, which is the new view. So if anything, in either perspective there, it looks like in the neoclassical model, the corporate tax is the way you want to raise revenue. The dividend tax is the way you want to raise revenue rather than the corporate tax, because the corporate tax is going to create distortions, whereas the dividend tax may create the same distortions, but if you're in the new view world, might actually not create any, right? Here, that result is exactly flipped. The dividend tax can actually have a higher efficiency cost than the corporate tax, and the reason for that is that it's the Harburger trapezoid logic, okay? So what's going on is you're already, so we want you to be at, say, this level of dividend payments here, okay? So this is this socially optimal level of dividend payments. But even without taxes, you're starting out paying too few dividends as the manager because you're doing all these pet projects. Now I come and put a tax on top, and that makes you pay even fewer dividends and invest even more in the pet project with the dividend tax. And so the deadweight loss created by imposing the tax is a first order deadweight loss, right? That I'm already underdoing the activity. I'm over-investing in the pet project, and I'm going to amplify that distortion and create a first order deadweight loss. In contrast, the corporate tax is only going to have the conventional second order deadweight cost, because it's only distorting the margin between productive investment and the outside option. Okay, so it's covered in more detail in the paper, but the basic logic is that the dividend tax looks really bad here because the firms are already hoarding too much cash. So what's a way to think about this intuitively, right? Microsoft in 2004, prior to the dividend tax cut, was sitting on $60 billion of cash. At the same time, Google was having its IPO. So from a social point of view, we might think it's productive for Google to have more cash and be able to invest at that point, right? Now, Microsoft is not going to directly invest in Google, a competitor. So we want Microsoft to pay out the money so that it can be efficiently reallocated to Google. Now, Microsoft, because of high dividend tax rates and the incentive to want to keep money within the firm because you want to have pet projects, empire building, and so on, is already paying out too little cash. And so when we cut dividend tax rates, potentially we significantly improve efficiency by changing the allocation of capital in the economy. That $32 billion special dividend gets put back in the market. Investors effectively, put more money into the Google IPO, right? Google now has a lot of capital and does good things with it, and that increases efficiency. That's basically the logic for why the dividend tax can potentially have a high efficiency cost. The corporate tax, in contrast, is just going to distort investment in the conventional Harburger way, which still has an efficiency cost, but is not going to be this first order efficiency cost from amplifying the agency distortion. So that logic suggests that dividend taxation, while it might not affect the aggregate level of investment in the economy, it might change the allocation of investment to occur more from companies like Google rather than Microsoft. What's the idea? If total investment that's measured is I plus J, right, then I can have ambiguous effects on investment. That when I cut dividend tax rates, I actually have less of this unproductive investment by Microsoft and more of the productive investment by Google. And so I may not see clear impacts on total investment consistent with Danny's paper, but maybe I see some allocative effects. And I think it's not totally clear, does that happen empirically? How important is that effect? I think that's an interesting question to investigate further, but I would say we don't exactly know. Okay? Questions? Yeah. And underinvest. Possibly, yes. Although you're already in an environment with taxes, so I don't think you'd get to a point where you. So it's possible with an intertemporal substitution motive that you'd underinvest. That's right. Yeah, I think that's right. So there's a lot of discussion in this literature. Alan Auerbach has a couple of papers and so on about what people's expectations for this tax cut were. And you can try to figure that out based on stock prices. I think it's not entirely clear. I certainly think, the Microsoft special dividend right after it certainly has the flavor of let's get the money out while we're sure the tax rate's staying low. But then over time, if it was all intertemporal substitution, we should have seen a reversion in dividend payments over the past decade. But you don't really see that. Dividend payments have stayed much higher than they were in the past. But that's correct, but the reason you're getting this first order efficiency cost here, which you would not get in the Feldstein model, is there's a divergence between the agent's objective function and the social welfare function, right? So the reason we get second order efficiency cost, if you think back to the exercise I've talked about many times, we've got the private surplus, which I usually put in the curly brackets, and then you add the revenue. And we assume that the agents in the economy are maximizing the thing in the curly brackets, the private surplus. In this model, that's not happening, right? Because the choices are being made not to maximize total private surplus, but rather the manager's objective function. And that creates a divergence between the two, which generates this first order deadweight cost from dividend taxes. That's why it's not exactly analogous to the.
When alpha equals 1.
When alpha equals 1, it is. No, but when alpha equals 1, you're back in the standard model.
Right, but that's also when the deadweight loss is largest.
No, it's when alpha is 0. When alpha is 0, close to 0, that the deadweight loss is largest.
G is a concave function?
G is a concave function, yes.
So
when alpha is small, you're going to be over-investing a lot. Right? Right, the marginal return, you're going to go to the point where the marginal return is very low. Yeah, it's a good question. None of this is taking that into account, right? Yeah, absolutely. So what's the logic? Something like, I see dividend taxes are lower, so I'm now going to consume less. This is basically the capital income taxation literature from the individual side. Do capital tax rates affect the amount that people consume and save? And we touched on that briefly, and I'll come back to that in a later part of this class where there are estimates of those elasticities as well, right? And I think one issue is to what extent are people actually paying attention to those things and so on. You see, I think attention is extremely important on the individual side, less so on the firm side because of the scale of these decisions. But yeah, you're right. You'd want to take that into account as well in a complete analysis. Okay, so the next thing we're going to talk about is dividends versus share repurchases. So in the preceding models so far, we've just assumed that firms can only repay money through dividends just for some ad hoc reason. But as we've discussed, firms can also return money to shareholders by buying back shares, which are taxed at a lower rate, capital gains rate, rather than the dividend rate. At least before the 2003 tax cut, that was certainly true. So why do you pay dividends given the tax advantage? People have thought a lot about that. There are two well-known theories of this. The first is an agency model, very famous paper by Jensen in 1986 that is potentially an explanation for dividend payments as well as many other things. The idea of the Jensen model is just firms have free cash flow that they would otherwise waste on perks. So if you have a firm with billions of dollars, they're going to find things to do with it that are not particularly productive. And dividends basically create a commitment to pay out some portion of your stream of profits. So Microsoft is going to earn profits for a while on its operating system, and I'm just going to commit to paying out X billion dollars of that profit every year and not make that decision in every period based on current conditions, which is what I would be doing with share repurchases. With share repurchases, every period you choose how much to buy back in shares. So it's a way to tie firms' hands. So that's fine, but if you step back one level, you've got to ask yourself, why are the dividends a commitment? Again, there's nothing in law saying you can't change the dividend payment, but they appear to act like a commitment. Like if Microsoft now says, I'm not going to pay dividends anymore, their share price will really take a hit. So it does have this commitment effect, but I don't think we have a deep model of why dividends end up being such a commitment. Okay, but given that they are, it can make sense in an agency model that you want to pay dividends, basically to tie your hands and cut down your ex post options for inefficiency. So basically, the way to think about it is you'd be more willing to invest in a firm that you know is going to pay dividends because you know that they're going to efficiently return the money to you and not ex post do something crazy with the funds. So that's one explanation, but I don't think it gets fully to the foundation of why dividends turn out to be the commitment device. A second model is a signaling model. So this is a bit more sophisticated reasoning, but you can see how it works potentially. So in Bernheim's model, it's actually because dividends are taxed that firms want to pay dividends. It's like the opposite of what you might think. Okay, and the reason is that the taxation of dividends makes them a way to burn money. So you are trying to, as a firm, like let's say as a manager, you're trying to maximize the value of your stock price, right? And so one way to signal that you're doing really well is to like throw a lavish party or something and say, look, I'm able to waste all this money. Obviously, we have a lot of productive things to do here. So another way to implicitly do that here is to pay dividends, which is essentially burning money by paying taxes, right? And so the firms that are going to choose to do that in a signaling equilibrium are the ones that have a low marginal cost of burning money. And what are the firms with a low marginal cost of burning money? They're the more profitable ones, for whom extra cash at the moment is not really that valuable. So in Bernheim's model, because you have taxes, firms use dividends as a way to signal their profitability. Okay, so as I say, that's like a sophisticated economist reasoning, I think, but it's logically a coherent explanation of why you'd have dividend payments. No, it's like it's a free market operation, right? I mean, so you can refuse to sell, and then they would say we'd be willing to offer you a higher price, and there's going to be some equilibrium there.
When they repurchase, they have to buy whatever shares are on the market.
Yeah, and at the prevailing price. And if they want to buy 50% of the company, presumably that's going to drive up the share price and so on.
Like, I sell it.
Well, then you would say I'm only going to sell it at a higher price, right?
Right.
I mean, presumably if they're going to give you
right, exactly.
some amount of money, you would.
Right. So
Yeah.
that would have to be.
Yeah, but the issue you're raising, it matters because Apple can choose when they buy back shares. So another explanation of what's going on here is the ability to time your share buybacks. So if I have insider information that Apple shares are currently undervalued and I'm going to put out a new iPhone that's going to be really successful, that's exactly when, as the firm, I want to buy back the shares, right? Because you don't know that, and I have that information, so I can basically generate value for myself from that point of view. And so that, again, makes share repurchases unattractive to investors because you then, thinking through the logic, are thinking, oh, you want to buy back shares now because you're trying to fool me. And so I prefer the dividends because I know exactly what's going on, right? So it's the same, it's like a asymmetric information issue. Yeah, that's another, I suppose one could have an equilibrium where it looks like that as well. So in Bernheim's model, it sets it up so it turns out this way. Yeah. So that motivates well the next slide, which is empirically trying to figure out what actually happens. Is the Bernheim signaling explanation a plausible explanation of why firms pay dividends, or the reverse? Okay, or the agency model, I should say. And so the way that Bernheim and Wantz have a very clever test to discriminate between these two models, they observe that dividend taxes should affect the announcement premium when you announce a dividend in opposite directions. It's very much along the lines of what you're saying. If you announce a dividend in the agency model, right, because when tax rates are high, agents get less per dollar paid out, the individual shareholders. When I go and say, as Microsoft, I'm going to initiate a $3 dividend, my stock price should rise less when tax rates are high. In contrast, in the Bernheim signaling model, now when tax rates are high, I'm showing that I'm burning more money when I announce this dividend payment. And so you would be even more impressed because the tax rate's 50% that you're paying dividends, and so the stock price should go up more, okay? And so Bernheim and Wantz used data from 1962 to 1986, and they find, looking at the time series patterns, that the premia, the announcement premium, is in fact higher in high tax regimes, which would go in favor of the signaling model rather than the agency model. Okay, so now I'm going to come back to this empirically to see whether we think this conclusion is robust, but that's the finding of the paper. Okay, now in order to talk about the more modern empirical literature on these issues, one thing that's kind of implicit here, but we're not being totally clear about, is we're pretending as if there is a dividend tax rate, right? And especially when you go to the data, you quickly realize that there's no such thing as the dividend tax rate because there are lots of people who face different effective tax rates on dividends. So first of all, because we have a progressive tax system, before the 2003 tax cut, the dividend tax rate varied across people. And second, non-taxable institutions, like I was saying, like pensions, are completely exempt, right? So in that environment, what is the effective tax rate? So a naive way of thinking about it might be, I'm just going to take an average of all the tax rates in the economy. But that is not a good way to think about it, especially with assets that are tradable, because if you think about what should happen in equilibrium, this goes back to a well-known paper by Miller, what we should do is trade so that on the date a firm pays a dividend, it's the pension fund that ends up owning the share, right? So I might own shares of Microsoft like most of the time, but every time they're going to pay a dividend, I should sell it to you, you're running a pension fund, and you don't pay any taxes on that dividend payment, and then you sell it back to me, et cetera, right? It's called a clientele effect. So at some level, you don't need to do any empirical work to know that doesn't happen to the extreme like that, because if it did, you would collect no revenue from the dividend tax, right? So the fact that you're collecting revenue from the dividend tax obviously means people are not arbitraging it away perfectly like that. Perhaps because of transaction costs, you're not going to deal with this back and forth trading. And so it's not, you can't just take the averages, but you also, based on this model, you might predict the effective tax rate is the min at 0, but that also doesn't appear to be true. So then you want to know empirically what is actually the effective tax rate on dividends in order to understand how it's affecting the announcement premia and so on. And so we'll pick up there in the next lecture.